8 additional years of retirement income from the same starting portfolio, same market return, same annual spending. All you change is one thing: the order in which you pull from your three types of accounts. This isn't a strategy from a product pitch. It's the conclusion of a line of research published continuously by Wade Pfau, Michael Kitces, and the Journal of Financial Planning since 2012. Replicated dozens of times, consistent across stress tests. The correct order of withdrawal can extend a standard retirement portfolio by an average of 8 years before depletion, compared to the naive order most people default into. And the naive order, the just take from whichever account is convenient order, is what almost every retiree actually does. Today, we're going to build the correct order from scratch. 3 account types, 3 withdrawal stages, 1 rule for each stage, and the exact crossover moment where the order flips. Think of your retirement savings as 3 water tanks. Each tank holds liquid with different tax properties. The taxable brokerage tank, every dollar you already paid tax on. Only future growth is taxed, and that growth is taxed at capital gains rates, which are generally lower than income tax rates. The traditional IRA or 401k tank, no tax has been paid. Every dollar that comes out is ordinary income, at your marginal tax rate in the year you pull it. The Roth tank, every dollar is already tax paid, and future growth is tax-free forever. The rule is deceptively simple, but almost nobody follows it, because it feels wrong. Before we go deeper, I built a free calculator that runs the exact withdrawal order math on your 3 balances and your spending. Link is the first line of the description. Plug your numbers in. Let's start with what most people do. The naive order. Most retirees pull from their 401k or traditional IRA first, partly because it's the biggest tank. For the average 65-year-old household with meaningful savings, roughly 70% of retirement money sits in pre-tax accounts. Partly because it's the tank most investment platforms default to, and partly because it feels like the retirement account. So that's the one you retire on. They leave the taxable brokerage alone because they think of it as a backup. And they leave the Roth alone because Roth is special. Save it for later. The naive order, traditional first, then taxable, then Roth, minimizes tax friction in the first few years of retirement, but it maximizes it over the full horizon. Here's why. When you pull from traditional first, you're spending your tax-deferred dollars in your early 60s, when your ordinary income tax bracket is typically the lowest of your entire retirement. Because you have no wage income yet, but you're leaving your traditional balance large at 73. When RMDs start, the RMD formula is unforgiving. Age 73, divisor 26.5. That means roughly 3.8% of your traditional balance is forced into your ordinary income every year, and the divisor shrinks every year after that, meaning the required percentage rises. If your traditional balance at 73 is 1.2 million, your first year RMD is 45,200. Add Social Security of 42,000. Add a pension of 12,000. You're at 99,000 of taxable income, and you haven't even spent a discretionary dollar yet. You walked out of your early retirement low bracket window without using it, and you walked into your RMD era high bracket window holding a full traditional account. This is the most expensive sequencing mistake in retirement. It can cost $300,000 to $500,000 over a 30-year retirement. Now the correct order. Stage 1, ages 62 to 72, roughly the first 10 years of retirement before RMDs begin. In this stage, you do 2 things simultaneously. You spend down your taxable brokerage account to cover living expenses, and you run aggressive Roth conversions out of your traditional IRA. Here is why. In these years, you have almost no taxable income, no wages. Social Security might be deferred, and even if you've claimed it, only 85% is taxable, and only above certain thresholds. If you're not pulling from traditional, your marginal bracket can easily be 12% or even 0. Taxable brokerage withdrawals are largely tax-free. You've already paid tax on the basis. Only the appreciation is taxed at long-term capital gains rates. And if your taxable income is below roughly $96,000 as a couple in 2026, your long-term capital gains rate is literally zero. Zero tax withdrawal to cover your living. Meanwhile, you're in an artificially low ordinary income bracket, which means you can run large Roth conversions, pulling from traditional, paying 12 or 22% on the conversion, and moving those dollars into the Roth tank for life. So the move list in stage 1. Spend your taxable. Convert traditional into Roth up to the top of your target bracket. Leave the Roth alone. It's the last tank you'll touch. The conversion amount should be calibrated to the top of the bracket you're choosing to live in. For most retirees, that's either the 12% bracket or the 22% bracket. If you're married filing jointly in 2026, the 12% bracket tops at $96,700. The 22% bracket tops at $206,700. The Roth conversion should fill but not exceed your target bracket. $1 over the line, and every dollar in the next bracket is taxed at the next rate. No gradation, no forgiveness. Meet a composite couple, Rick and Nancy, 64 and 62. Portland, $340,000 taxable, $1.35 million traditional, $280,000 Roth. No pension, delaying Social Security to 70, annual expenses, $78,000. Their move in stage 1 is elegant. They pull $68,000 from taxable to cover living expenses. The basis portion is return of capital, and the gain portion falls inside the 0% long-term capital gains bracket. Net federal tax on their withdrawal, essentially zero. Simultaneously, they do a $90,000 Roth conversion every year. Converting up to the top of the 12% bracket. Total tax on the conversion, roughly $10,800, paid from their taxable account. Over the 10-year stage, they move $900,000 out of traditional and into Roth. Total tax paid during the 10 years, roughly $110,000. Average effective rate, and 12%. You think Roth conversions are for the wealthy. You're wrong. Roth conversions are for anyone in a low bracket gap year. If your marginal rate at 64 is materially lower than your projected marginal rate at 73, you are a Roth conversion candidate. That describes most early retirees. Stage 2, ages 73 to 82, the first decade of RMDs. At 73, required minimum distributions begin, and they override the optimal order. You have no choice. The IRS formula forces a specific percentage of your traditional balance out of the account every year, whether you need the money or not. But, and this is the critical point, the specific percentage is much smaller if you've used stage 1 correctly, because you moved hundreds of thousands out of traditional during the Roth conversion window. Rick and Nancy walked into stage 1 with $1.35 million in traditional. They walked out 10 years later with roughly $650,000. Not because they spent it, but because they converted more than half of it to Roth. Their first-year RMD at 73, roughly $24,000, against Social Security of $62,000 combined. Plus any taxable brokerage remaining. Their taxable bracket in stage 2, 22%. If they hadn't done the conversions in stage 1, their RMD alone would have been roughly $51,000. And combined with Social Security would have pushed them into the 24% bracket and generated IRMAA cliffs on Medicare. Stage 2 move list. Take the RMD. It's mandatory. If the RMD plus Social Security covers your spending, you stop there. If there's a gap between what the RMD covers and what you spend, fill it from the remaining taxable balance, still at capital gains rates, lower than ordinary income. The Roth still doesn't get touched. You are preserving it for stage 3, the most expensive years. Meet Margaret, a composite. 78, Asheville. Widowed 3 years ago. $420,000 traditional, $45,000 taxable, $640,000 Roth. Social Security, $2,650 a month. Annual expenses, $56,000. Because she's filing single now, her tax brackets are much tighter than they were when her husband was alive. The 12% bracket tops at $48,500 for a single filer in 2026. The 22% bracket tops at $103,350. Her RMD this year, roughly $18,000, Social Security taxable portion, 7,600. Total ordinary income before any discretionary withdrawal, 25,600. Well inside the 12% bracket. She has 30,400 of remaining room in the 12% bracket before she crosses. Her spending gap, she needs approximately 30,000 more to cover her expenses. She takes that from her remaining taxable brokerage at capital gains rates and leaves the Roth untouched for another year. You think RMDs hurt you. They only hurt you if you didn't use stage 1. If you converted aggressively in your gap years, your RMDs in stage 2 are a fraction of what they would have been. In Rick and Nancy's case, half. In more aggressive cases, a third. Brief pause. 8 additional years of retirement from nothing but the order. If this is the math you wish your advisor had walked you through, subscribe. New breakdown every Wednesday. Stage 3. Ages 83 and beyond. This is where the order flips one more time, and where most withdrawal order content stops explaining. At age 83 or so, two things happen. Long-term care risk starts to rise meaningfully, and the probability of one spouse predeceasing the other begins to concentrate in this decade. Both risks change the tax math. When one spouse dies, the surviving spouse transitions from married filing jointly to single, and their tax brackets roughly halve. The 12% bracket drops from 96,700 to 48,350. The 22% drops from 206,000 to 103,000. At the same income, the survivor pays dramatically more tax, which means every dollar of ordinary income during this phase, every traditional IRA withdrawal, hits a higher bracket than it did while both spouses were alive. And long-term care expenses, which average $108,000 a year for a private room in a skilled nursing facility in 2026, create their own bracket compression. A single-year LTC event can push a surviving spouse into the 32% bracket entirely on its own. Stage 3 move list. Roth becomes the primary source. Every dollar pulled from Roth is zero ordinary income. No bracket pressure, no IRMAA pressure, no survivor penalty pressure. It's the one tank that behaves the same, regardless of filing status or long-term care expenses. Traditional, you still take the RMD because you must, but you don't take a dollar more. Every dollar of traditional in this phase is the worst tax dollar in your retirement. Taxable, for most retirees following this strategy, is largely depleted by stage 3. Meet Edward, composite. 86 Milwaukee, widowed. 280,000 Roth, 190,000 traditional. 68,000 in annual expenses. Now includes $4,200 a month for early-stage long-term care at home. Annual expense total, approximately $118,000. Social Security and the RMD cover roughly $68,000. Gap, $50,000. If Edward fills the gap from his traditional, that entire $50,000 is ordinary income at single filer brackets. Stacked on top of his Social Security and RMD, it pushes him into the 24% bracket, plus an IRMAA cliff on Medicare. Combined cost roughly $17,000 in additional taxes and premiums. If Edward instead fills the gap from his Roth, zero additional tax, zero IRMAA impact. The full $50,000 goes directly to care. Net savings, $17,000. Over 3 years of care, roughly $50,000 saved, which, in his situation, is the difference between outliving his assets or not. You think Roth is a legacy asset, something to pass to your children tax-free. It can be, but before that, it's something else. It's longevity insurance. For the last decade of your life, when every other tank becomes more expensive to draw from, the Roth is the one that doesn't compound the tax penalty of aging. That's its real job. Here's the full portrait. 2 identical households, $1.5 million starting balance. Same annual spending, $78,000. Same market returns. Household A uses the naive order, traditional first. Portfolio depletes at age 87. Household B uses the correct order, taxable first. Roth conversions in the gap years, Roth last. Portfolio depletes at age 95. 8 additional years. Of funded retirement. Of quality of life. Of not being dependent on adult children or public assistance. Same money. Same markets. The 8 years is not a marketing claim. It's what the tax code pays you, in silence, for getting the sequence right. Three mechanisms drive the 8-year gap. 1. Filling the low bracket gap years with Roth conversions moves money out at the lowest effective rate of your retirement. 2. Shrinking traditional before RMDs hit means smaller forced income in Stage 2. 3. Preserving Roth for Stage 3 insulates you from survivor filing status brackets and long-term care bracket pressure. Each mechanism compounds on the next, which is why the total savings is not linear. Takeaway 1. Tonight, map your 3 tanks, open each retirement account statement. Write down 3 numbers. Taxable brokerage balance. Traditional IRA plus 401k balance. Roth IRA plus Roth 401k balance. If any tank is 0, that changes the strategy, but you need to see all 3 numbers on one sheet. Takeaway 2. Identify your gap years. For most watchers, that's age 62 through 72. Then identify your target conversion bracket. 12% if your traditional balance is under 800,000, 22% if it's larger. Every year you skip a conversion in this window, you're losing optionality for life. Takeaway 3. Do not touch the Roth in stages 1 or 2. I know it's tempting. Why pay tax in stage 1 when the Roth is already tax paid? Because the Roth's job isn't to make year 64 easier. Its job is to be liquid and untaxed in the most expensive years of your life, age 83 through 95, when every other tank has become more expensive to drain. That's when you use it. The order is the strategy. Everything else is just the balance. 2 retirees with the same million-dollar portfolio, same market, same spending, can end up with an 8-year gap in how long their money lasts, based on nothing more than which tank they drain first, second, and third. The math is old. Fau published it. Kitces publishes it every quarter. The Journal of Financial Planning has run the stress tests. The answer is not in dispute. What's in dispute is whether you'll run the math on your own 3 tanks before your first withdrawal or after your 1,000th. Cure your license to chill. Fix the wealth drain today.